Investors are preparing, of course, for a 1-2 punch of inflation data, and the results could impact the Fed's rate cut timeline during the second half of the year. Joining me now with more is Bill Adams. He's a chief economist at Comerica Bank. Bill, welcome to the show. It's great to have you. And what are you expecting this week when it comes to inflation and the impact on stocks?
Good morning, Kristen. I'm expecting the CPI report to show that gas prices were lower in May, and that held down overall prices for American consumers. But we're going to start to see some pass-through of tariff costs to durable goods on American shelves and in American budgets.
So what does that mean for consumers? By and large, a 2.5% year-on-year gain. Do you think that that's something that's in line with your own forecasts?
2.5% CPI inflation is not bad. The Fed targets inflation of 2% by a slightly different measure that runs about 0.25% below the CPI. So we're pretty close to the Fed's target in the first half of this year. I think the issue is that with tariffs passing through to consumer prices, inflation's likely to pick up in the second half of the year. That's what we're seeing through recent consumer surveys and from business surveys. Last week, we got PMI data showing that business input costs are rising at the fastest pace since 2022. So sooner or later, that's going to push the CPI in a higher direction. That makes the May CPI report a little bit dated, even though the data for May is probably, again, still pretty good.
Yeah. How does the jobs picture factor into this, Bill? Of course, we do see job gains starting to slow, but still staying steady above 100,000 each month.
The jobs report for May was, I'd give it a B-. The headline was good with 139,000 jobs on the month. The unemployment rate stable at 4.2%. But you look beneath that, the components of the survey by which the unemployment rate is measured, we saw employment fall in that survey. We saw labor force participation fall in the survey. The job growth that we saw in May was disproportionately concentrated in healthcare jobs, which are less cyclical. More cyclical sectors have seen a big slowdown in hiring. So we are seeing some deterioration around the edges of the job market, but not enough that the Fed would consider cutting rates in the near term. So we think the Fed's likely on hold, at least for the next couple of decisions. And then the outlook beyond that really depends on how much tariff pass-through to inflation we see in the second half.
Is there any risk that the Fed, amid this dynamic environment, certainly when it comes to trade policy and the funnel through to data, Bill, that the Fed is too late on cutting rates if that is indeed its next move?
I think we could see the Fed keep their foot on the brake for a considerable period. Now, is that too late? I think that will depend on what happens to inflation. We haven't had such a large increase in tariffs in generations in the United States. We're not sure how businesses and consumers will react to this. And inflation expectations have been rising due to the inflation surge of the last couple of years. So the Fed is concerned that inflation, even though it seems like it should be a one-off hit to inflation from higher tariffs, we might see a more persistent increase in inflation expectations, which could be self-reinforcing. And that's why the Fed doesn't feel comfortable cutting interest rates now or likely in the near term.
Interesting. And in terms of the knock-on effects here, Bill, anything more you can share? And of course, how that could funnel through to equity prices?
I think inflation right now is having the biggest effects on retail businesses. They're confronting that margin pressure. Manufacturers are also, we're seeing, it's a combination of the direct price effect of tariffs, but also the uncertainty of not knowing what tariff policy is going to be in a month or in a year or by this afternoon. And because of that, a lot of manufacturers have been slow rolling their hiring and investment plans this year. And that's caused a slowdown in manufacturing activity overall. We saw that in the May jobs report with a modest decline in manufacturing jobs in May month. I don't see that as a recession, but it does look like the economy is going to be in slow gear near term.
You know, we've seen some big IPOs of late. Certainly Circle here at the stock exchange last week was a blockbuster, providing some momentum with the S&P 500 just about 2% from its record high. It seems like consumer sentiment is improving, and we will get reads on that this week. Bill, do you see that as well?
Consumer sentiment looks like it's stabilizing to me. I think consumers have been in a funk for a couple of years now. If you look at where sentiment is today, it's down from the turn of the year, but in the last couple of reads, it's been more stable. In a decade or 2 decades ago, consumer sentiment would give you a great advance read of what was likely to happen with consumer spending. In more recent years, consumers have been saying one thing and then doing another when it comes to actually spending. So I'm hopeful that this year, while we see some signs of caution from consumers, over the next couple of months, we'll see consumer sentiment stabilize, and with that, consumers go back to spending and keeping the economy moving forward.
All right, Bill Adams, he's chief economist at Comerica Bank. Bill, thank you.
Thank you.